In this video I will talk about tick size and daily price bands. Let's first understand what is tick size. Tick size is the minimum price change between best bid and best offer of an asset traded on an exchange. It is the minimum price difference that must exist at all times between consecutive best bid and offer prices. See, now in NSE, that is on National Stock Exchange, the tick size for all equity shares and also for derivative segment is 0.05. Now let's take one simple examples to understand this. Let's say a Dish TV stock has LTP, that is last traded price of rupees 100. Then the next 5 bid prices for the stock shall be rupees 99.95, rupees 99.90, rupees 99.85, rupees 99.80 and rupees 99.75. As you can see, these 5 bids have a difference of 0.05. This means bid price cannot be rupees 99.97 or 99.93 or even 99.87 because these numbers do not meet the tick size of 0.05. So remember this point, tick size is the minimum price change between best bid and best offer. Now let's talk about daily price limits. Now first I would like to explain this concept from Indian markets point of view. Now when it comes to price limits, now you can also call this as a price band. Okay, price limit or price band. They are typically meant to avoid vertical correction in the stock. See, in India, many retail traders buy stocks of small cap and mid cap companies. These stocks are more vulnerable to the wild moves in either direction. This means there is huge volatility in mid cap and small cap stocks in either direction, that is either on upside or on downside. So these price bands are meant to provide protection to the retail investors against big losses. See, recently in the month of March 2020, we got to see price hitting lower band of 5% on multiple occasions in the script of IRCTC. Now thanks to the price band, because if there was no price band at 5%, there is possibility IRCT stock may fall more than 5% in a single day. Once price reached either upper band or lower band, the trades halt at those levels. So that's why price cannot move beyond upper band or lower band. Once price hit price band, trade will halt. If any script has a price limit of let's say 5% and yesterday closing price is rupees 100, so for next day price can trade in the range of 95 to 105 because the 5% of 100 rupees is 5 rupees. So for next day the price range will be 95 to 105. 95 will be called as a lower band and 105 will be termed as upper band. Once price hit either 105 or 95, trades will not take place at those levels. No trades can take place above 105 and below 95. Now let's understand the concept of limit up. If price hit rupees 105, then price is set to be limit up. If price hit rupees 95, then price is set to be limit down. If we talk about contract, derivative contract, the contract is set to have a limit move. Now let's understand what is locked limit. See, if trades cannot take place because of limit move, okay, limit move happens because price has reached limit up or limit down. So if price reached limit up or limit down, contract is set to have a limit move. If trades cannot take place because of limit move either up or down, the price is set to be locked limit. Since no trades can take place and traders are locked into their existing position. So now in Indian derivative markets, price limit is applicable only to equity scripts, those scripts which are not part of the derivative segment. If script is a part of derivative segment, there won't be any price limit on that script.